What's up, traders, and welcome back. In today's video, we're going to be talking about some of the measures of U.S. trade and Fed action. Specifically, we're going to go over the U.S. trade balance, Fed balance sheet assets, M1 and M2 money supply, total public debt, and the debt to GDP ratio. In all reality, these are fairly complex topics with a wide range of implications in both the short-term and long-term timeframes. So specific to our goals as traders and investors, we're going to be focusing on the implications of the changes in these numbers as they relate to our macro outlook. Having a baseline understanding of what's going on with U.S. trade and how the Federal Reserve is reacting to the current economic environment is going to help us to form that baseline opinion about the current economic conditions here in the United States. Again, the better that we can develop our macro view, the more informed we are about what's been happening, what's happening now, and what's likely to happen next. Identifying those key drivers of the financial markets helps us become more sophisticated, more prepared, more agile investors. So without further ado, let's jump in and talk a little bit more about U.S. trade and Fed action. Let's begin our discussion today with the U.S. trade balance. Now, the U.S. trade balance measures the net total of exports and imports between the U.S. and foreign countries. It's calculated by subtracting net imports from net exports. So when the U.S. trade balance is negative, it signifies a trade deficit, meaning that the United States is importing more than it's exporting. Conversely, whenever that number is positive, it signifies a trade surplus, meaning the U.S. is exporting more than it's importing. So what's better, a trade deficit or a trade surplus? Well, that's highly dependent on the country in question. Depending on the current goals and economic conditions of a society, it can be advantageous to either run a deficit or a surplus. Running a chronic trade deficit or trade surplus has much broader implications for the long-term health of a society and is beyond the scope of this video. Instead, we're going to focus on how we can use the U.S. trade balance and fluctuations in the U.S. trade balance as an indication of the current economic conditions and the likely effect on the US dollar. Why is that so important? Well, if you've already watched our video on intermarket analysis earlier in this series, you'll know that the US dollar plays a pivotal role in some of the central relationships in the market. If you get the dollar right, you get a lot of things right. So having a better understanding of what's likely to happen next with the dollar really helps to inform our macro opinion. And one of the many drivers of dollar strength is the U.S. trade balance. So there's a couple of important concepts to understand related to the U.S. trade balance. First of all, whenever U.S. consumers and businesses purchase foreign goods and services, we have to exchange U.S. dollars for that foreign currency in order to purchase those goods and services. When we do that, U.S. dollars are effectively leaving the country. On the flip side of that, whenever U.S. businesses export domestically produced goods and services, the foreign purchasers have to exchange their local currency for U.S. dollars. So whenever we export goods, demand for the U.S. dollar increases because those foreigners need U.S. dollars to purchase our goods. This boost in demand for the dollar increases its strength and makes it more valuable relative to foreign currencies. And that's at the heart of my approach to using the U.S. trade balance. What effect will fluctuations in the U.S. trade balance likely have on the U.S. dollar, and by extension of that, on the stock market? And how do those things fit into my macro narrative? So let's pop into the market barometer to take a closer look at the trade balance and see how we might interpret this. So here we are in the U.S. Trade Fed Action tab of the macro section of the market barometer, and we have the U.S. trade balance in the topmost chart here. So an important point about U.S. trade is that we've been running a chronic trade deficit for about 50 years now. In fact, if I pull the date range back to 1970 here, you can see that's around the time that we started to run a trade deficit and have ever since. So again, there's plenty of reasons as to why that is and much broader implications as to what that means for the future of the United States and the health of our economy. But again, those things are outside of the scope of this video. We're going to be focusing on short-term fluctuations in the trade balance and the likely effect that that's going to have on the strength of the dollar. So zooming in here, I'll bring us up to just the last few years or so. And this is actually a very interesting time to be looking at this because, today is what, December 11th, 2020. We're about 8 months or so past the fallout from the coronavirus pandemic. You can see that happening here. This is what, February of 2020. So you can see the next data point here, March 2020, the trade deficit really started to deepen, and it basically has ever since. So what's that telling us? Well, in light of everything happening in our country right now, and regardless of if this is more of a factor of a decrease in exports or an increase in imports, we know that the effect is that there is less demand for the US dollar. So this deepening of the trade deficit over the last several months should be contributing to dollar weakness. That's not to say that the dollar is definitely weakening, as this is only one of the influential factors on the price of the dollar. But it's a big one, so let's quickly take a look at the dollar and see what's been going on with it over this same time frame. Sure enough, the dollar's in a significant downtrend over that same time frame. In fact, it's down almost 15%, which, might not be a huge move down in a volatile stock, but in a currency, especially the world's premier reserve currency, a 15% move down is substantial, to say the least. So the deepening trade deficit definitely confirming the dollar weakness over the last several months. So now we have one more clue as to why the dollar has weakened, because the trade deficit has deepened. And if the trade deficit improves in the future, we could expect that that would be at least one positive factor influencing a stronger dollar. So throughout the rest of this video, we're going to look at more clues, more things to either confirm or deny what's happening right now. And the more that we understand more pieces of this puzzle, and the more that we track and monitor what those pieces of the puzzle are telling us, the better we're able to forecast what's likely to happen in the future. And the better we're able to identify those pieces of the puzzle that are exhibiting a stronger influence. All that said, the next clue we're going to be taking a look at is the Fed balance sheet assets. This measure refers to the total cumulative assets on the Federal Reserve's balance sheet. Now, again, the Federal Reserve is the central bank of the United States, and it's responsible for what's called the dual mandate. This dual mandate lays out the two main goals of the Federal Reserve, those being to keep inflation in check and to keep employment at healthy levels. The Fed has an arsenal of tools at its disposal that it can use to help it achieve its monetary policy goals, which again are centered around healthy levels of inflation and employment. The traditional tools that it uses are the discount rate, which effectively helps them influence prevailing short-term interest rates. They can also adjust reserve requirements and engage in what are called open market operations. So check out the fiscal versus monetary policy video in this series if you want to learn more about monetary policy. For now, that last tool I mentioned, open market operations, that's what's relevant to this Fed balance sheet assets measure. Open market operations refers to times when the Federal Reserve purchases and sells U.S. government securities, namely U.S. government treasury bonds, on the open market. When they buy U.S. treasuries on the open market, it influences the money supply, which in turn influences short-term interest rates. When the Fed purchases securities on the open market, it adds money to the system, making it easier to obtain loans and pushing down interest rates. This is known as expansionary monetary policy, when the Federal Reserve is expanding the cumulative assets on its balance sheet and expanding the money supply. In contrast to that would be contractionary policy, where the Federal Reserve sells the assets on its balance sheet in the open market, effectively reducing the assets on its balance sheet and reducing the money supply. So as investors, what does this number tell us and how do we use it? Well, first of all, it clues us into the Federal Reserve's outlook for the economy going forward, right? If they are engaging in expansionary monetary policy and expanding the assets on their balance sheet, it means that they're trying to stimulate the economy, implying that they have a dim outlook for the economy moving forward. And in that same vein, when we track what the Fed has been doing and to what extent they've been doing it, we can have a better idea of the effect that that's likely to have on the economy, on the money supply, and on interest rates. So let's jump into the market barometer and take a look at the Fed balance sheet assets and see what that implies about what's been happening, what's happening now, and what's likely to happen in the future. Again, here we're in the macro section of the market barometer on the U.S. Trade Fed Action tab. And we have the Fed balance sheet assets here on the left-hand side. I'm going to go ahead and enter full screen mode on this chart here so we can get a closer look. But this is really an interesting time to be considering the Fed's balance sheet asset because the last 15 years or so, the status quo has really changed. Looking back to mid-late 2008, you can see that was the first round of quantitative easing in light of the financial crisis. Well, quantitative easing basically just refers to a series of actions taken by the Fed to stimulate the economy. So first of all, they lower interest rates via the discount rate. They also lower the reserve requirements. And on top of that, they engage in open market operations, expansionary monetary policy via open market operations. They're buying US treasuries, and the cash that they're using to buy those treasuries is going to the banks from which they purchase those treasuries. The banks then have extra cash that they're able to lend out to businesses and individuals. Where does the cash come from that the Fed uses to purchase these securities? Well, they're creating it de novo, right? Anew. They're creating new money and they're purchasing government debt, injecting that money into the economy. This is known as debt monetization. So again, this has a stimulative effect on the economy. And we can see that trend in the Fed's balance sheet assets really moving up and to the right over the last 15 years. It started with the great financial crisis and the first rounds of quantitative easing in late 2008 and has pretty much extended through now. So it got kind of put on hold around 2014 or so. And in fact, the Fed tried to reverse course and move to a period of quantitative tightening where they started to sell back some of those US treasuries on the open market. So you can see the Fed's balance sheet actually contracting a little bit in 2017 into 2018. They also started to raise interest rates at that time, and it didn't have a very good effect. While that was definitely the responsible thing to do, the economy and the stock market did not react to it in kind. And if you guys remember, actually there was a pretty bad sell-off in late 2018 that led to the Christmas Eve massacre where the market was down several percent on the day. That was actually my first experience with a swift, volatile sell-off in the markets. So I certainly remember that time pretty well. But you can see that the Fed's balance sheet at that point started to expand again. And then here we are, several months after the coronavirus pandemic fallout. And we've moved once again to a very expansionary phase as far as the Fed balance sheet assets are concerned. With the Fed monetizing a lot of the debt that the US government is creating in order to, provide stimulus. So a huge boom in the expansion of the Fed's balance sheet assets over this last year. So you can see going through this exercise and looking at this chart really helps to bring confirmation to what we already know the Fed has been doing. You hear that the Fed's been expanding its balance sheet and doing what it can do to stimulate the economy and purchasing treasuries on the open market. Well, this chart is measuring that. It's telling us when these things have happened and to what extent they've happened. And it's important to us as investors because it's going to have a direct effect on economic productivity and the value of the dollar. So another good chart to look at to measure the effect that the expansion of the Fed's balance sheet is going to have on the dollar in particular is to look at the money supply. So to what extent has the Fed created new money to monetize this government debt? And by extension, how fluctuations in the money supply are likely to affect the value of the dollar. So the money supply refers to funds that are readily accessible for spending. So we're talking about cash, cash equivalents, and other assets that are easily converted into cash. So when we say money supply, we're just talking about the size of the pool of money available to the public. M1 and M2 money supply are basically just two different categories of what's considered cash and what's considered part of the money supply, with M2 being a more broad category. So M1 only includes cash and cash equivalents such as travelers checks and demand deposits, but M2 goes on to include all of the M1 categories as well as a broader set of financial assets that are held principally by individual households. Now again, the value of the US dollar is a complex topic with many factors affecting and influencing the value of the dollar, but M1 and M2 money supply is certainly one of those factors and a very important one. As a general rule, the more money that's available to the public, the less value each unit of that money will have. So as the money supply increases, the value of the dollar should decrease. Now again, that's a one-dimensional way of looking at it, and this is only one factor that affects the value of the dollar. But again, it's an important one, and by measuring and monitoring the money supply, we have one more clue as to what's driving the value of the dollar. So here we are back in the market barometer, again on the US Trade Fed Action tab, and we have the M1 and M2 money supply here on the right-hand side. So you can see that over that same time frame since about 2005, the M1 and M2 money supply has generally trended up, with a big spike here at the beginning of 2020 in response to the stimulus measures by the U.S. government and the Fed monetizing much of that debt. So the money supply really exploding over this last year. And again, that kind of plays into the devaluing of the U.S. dollar over this same time frame. So far we have the U.S. trade balance, the Fed balance sheet assets, and M1 and M2 money supply all supporting that strong move down in the value of the dollar. Lastly, we have the total public debt and the debt to GDP ratio. Now, these two measures are more long-term indicators of economic health. But the total public debt is the sum of accumulated outstanding debt owed by the federal government to the public and intra-governmental departments like Social Security. Now, in the short term, increased debt can stimulate the economy by providing funds for a country's growth without the need to raise taxes. So debt really facilitates growth in a lot of ways. But when debt grows too large, especially as a percentage of gross domestic product, GDP, it can have an inhibitive effect on the economy, causing more of a government's revenue to be spent servicing its debt rather than investing in growth. So eventually, too much debt and the accumulation of too much debt, especially as it relates to GDP, can become very inhibitive on economic growth. So if the debt that's accumulating is not being used effectively and productively to increase GDP, then servicing that debt becomes more inhibitive than the new debt is helpful as far as stimulating GDP growth. Taking on new debt that doesn't stimulate enough productivity that allows the debt to pay for itself becomes a burden. And the longer this happens, the more that burden grows. And that leads to a debt crisis. So total public debt can continue to grow as long as there is commensurate growth in GDP. And a quick way to measure and monitor that is through the debt to GDP ratio. So the debt to GDP ratio just takes the total public debt as a percentage of GDP. And in case you haven't seen the video on productivity and growth metrics yet, GDP is gross domestic product and essentially is a measure of the total goods and services produced by the United States. So monitoring fluctuations in the debt to GDP ratio gives us an idea of whether or not growing debt is being met by commensurate GDP growth. Now, the tipping point of a healthy debt to GDP ratio is about 77%. Now, that's a rough general kind of rule of thumb. So with a debt to GDP ratio rising above 77%, investors will become more and more nervous about a country's ability to pay down its debts long term. So investors are inclined to demand higher interest rates, higher rates of return because of the perception of increased risk when purchasing government issued bonds. So back into the market barometer, you can see we have the total public debt and debt to GDP ratio at the bottom of the US Trade Fed Action tab of the macro section of the software. So we're looking at the last 50 years here, and we're seeing persistent debt growth and starting to accelerate faster and faster over time as well. So again, growing debt isn't necessarily a problem in and of itself. You just want to ensure that it's being met with commensurate GDP growth. So before we talk about the debt to GDP ratio, let's jump over to the production growth tab and look at GDP itself. So also looking at the time frame since 1970, you can see GDP also growing over that same time. So the way that we relate these two charts is through the debt to GDP ratio to see to what extent they are both growing in lockstep with each other. So back to the US Trade Fed Action tab, looking at the debt to GDP ratio, you see all through the 70s and 80s, it was within a very healthy range. You know, in 1989, we're looking at here, it was at 51.38, meaning that at that time, for every dollar of GDP being produced, there's only about 51 cents worth of debt. So an incredibly robust debt to GDP ratio. Since then, the debt to GDP ratio has slowly increased. And in fact, it reached for the first time above that 77% threshold of a healthy level in 2009, right around the same time that the first wave of quantitative easing was taking effect. So interesting to look at the timeline of these things happening. Then in the 2010s, debt to GDP breaching 100 for the first time, meaning that for the first time, there was more debt than there was GDP in a given period. And then another notable spike in the debt to GDP ratio here in 2020 at the very far right side of the chart there. So what is this telling us? Well, the total public debt really started to accelerate around the great financial crisis, 2007, 8, 9. And at that same time, the debt to GDP ratio worsened. So it's telling us that all this new debt is not necessarily being used productively to increase decreased GDP growth, and the US debt to GDP ratio is only worsening. So again, this is a longer term trend that we're looking at here that has much broader implications as to the future health of the US economy, but it's one more piece of the puzzle and one more piece of confirmation we're getting as to the decline in the dollar right now. A worsening debt to GDP ratio like this implies more risk and slower economic growth. All of these things equating to more downward pressure on the US dollar and a dimmer outlook for the US economy moving forward. So the long-term trends are unfortunately moving in the wrong direction for the United States, but that doesn't necessarily mean that the stock market and the economy are going to tank tomorrow, right? The Fed is going to continue to do what it can do to prop up the economy and the stock market, and that's why it's so important and helpful to us as investors to keep tabs on how the Fed is reacting to current economic conditions and what that likely means for the economy and the stock market. There we go, folks. A quick look at some of the measures related to U.S. trade and Fed action. Keeping tabs on these various metrics helps us keep an eye on what's shaking and moving in the economy and how the Federal Reserve is responding to that. These numbers help bring the long-term health of the U.S. economy into view and also helps us to determine what the likely impact on the U.S. dollar will be. So if you guys like this video, don't forget to subscribe to our channel, hit that like button, leave any comments or questions down below. Continue on with the macroeconomic crash course series to help you become a smarter, more sophisticated, higher probability investor and trader. For now, I'm your host, Neil. Thanks so much for tuning in, and we'll see you guys in the next video.